The ECB, 15 minutes away. Live from New York City this morning. Good morning, good morning. Equity futures down 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, tensions simmer, leaving regulators on alert as Credit Suisse taps a central bank lifeline and President Lagarde makes her next move. We begin with the big issue between a rock and a hard place.
It's a very, very difficult environment now.
You got a little bit of whiff of financial instability.
The market is telling the Fed to be done.
Doesn't change the fact that we have inflation still above trend here.
The market doesn't care that the inflation is still there.
The data would say you need to hike.
The labor market is still strong, inflation is sticky.
And we've got financial stability risks pointing the other way.
Now the questions are what comes next year for the system.
Taking a breather on the rate hike process is prudent. I think that would make sense.
If they had to pause in March, they could certainly do that.
But that doesn't mean that's what they're going to do.
We're pricing 0 versus 25.
It's very soon to make a call on the Fed being done.
I think it's very much up in the air at this stage.
It's all up in the air at this stage. 3 crucial stories for us this morning. First, the future of Credit Suisse, a looming ECB rate decision, and Secretary Janet Yellen on Capitol Hill. Your team coverage starts right now with Ollie Crook joining us from Zurich, outside of Credit Suisse, Maria Tadeo in Frankfurt, and Mike McKee here in New York. Maria, first to you. Bloomberg reporting in the last 20 minutes or so that ECB Vice President Luis de Guindos told finance ministers on Tuesday that some EU banks could be vulnerable to rising interest rates. Maria, can you give us some perspective on what's happening?
Yes, Tom, Jonathan, excuse me, because the timing here, it's important to clarify one thing. This happened in the wake of the Silicon Valley Bank. This happened on the Monday, Tuesday. This is a regular meeting where finance ministers of the Euro area and the European Union essentially get together to talk about economic issues. And obviously, we know that Luis, again, this is a vice president of the European Central Bank, who's also in charge of some of the financial supervision. So we were expecting that there was going to be an update on that situation. Again, it's important to clarify the comments happened on Tuesday. So this was before Credit Suisse really became front and center yesterday, and the fears around the European banking sector really spiraled yesterday. So the timing is important to stress. This happened on Tuesday before Credit Suisse. Now, a lot of those comments about, well, this change in rate cycle and the impact that it could have on banks to some extent were expected in the wake of SMB, and we had the head of the Eurogroup who I spoke to on the Monday already, who already told me on the record that that was going to be a point of conversation. So to some extent, it's more pegged to that story than the Credit Suisse fallout yesterday.
Maria, I'll come back to you on the ECB in just a moment. Looking at Credit Suisse up by more than 20% in Swiss trading. Ollie Crook, has the SMB, has the Swiss regulator, have they done enough?
Well, this is the big question for Credit Suisse today. Have they done enough? I mean, this is an act that does not have precedent since the financial crisis. And really, that is the open question this morning. Will it furnish enough stability for enough time for Credit Suisse and its own management to turn this bank around? And really, when you look at the fragility here, that is not a very clear question to answer. What triggered this yesterday was on very little tangible news. So looking as we do going forward, the stability today, yes, is important, but the willingness of other banks to continue to do business with Credit Suisse, of other clients to continue to do business, and longer term, the outflow picture. What does yesterday's episode do for the outflows? And then even longer term, this is a bank already in the throes of a very difficult turnaround. This cannot be good for morale. It is certainly not good for the cost of doing business. And so looking ahead, even if Credit Suisse walks away today and this is all that they get from the SMB, they have an even larger challenge ahead of them than they did just a couple days ago.
Secretary Yellen's going to come up talking about some of this as well. Ollie, thanks for that. You'll hear from Christine Lagarde at 9:45 Eastern time, so about 40 minutes from now. The decision from the ECB about 10, 11 minutes away. We've got the text from the prepared remarks for the Treasury Secretary. Here's a quote, Mike McKee. Our banking system remains sound. Americans can feel confident that their deposits will be there when they need them.
Well, that is true. However, where do we go from here? That's going to be the real focus of this. Now, Yellen's going up there to defend the president's new budget, which everybody knows isn't going anywhere because that's the way it works in Washington. So there'll be a lot of questions about what the Treasury, Fed, and FDIC have done over the past week with the banks. We've obviously got some problems still with the First Republic folks this morning, so it is not over. Yellen, in her remarks, says that basically the administration's line, SVB and Signature, got their money, the depositors, no taxpayer money used. The FDIC is funded by bank fees, even though those bank fees will probably come in the sense of higher fees to customers. No new lending facility. The new lending facility from the Fed should help, but she doesn't comment on why regulators missed what happened at SVB, and that is going to be a real focus of this. A lot of questions will come to her on how it's possible that regulators let this bank get away with this and how it got through, about how the FDIC is going to fund their bailouts and whether or not that's going to take a big bite out of consumers' wallets. And of course, what does it mean for the future? Are we creating a lot of moral hazard? Is this becoming sort of a public utility banking? So there's going to be some contentious questioning of the secretary. Might get a few questions in about the budget.
Without a doubt. And I think the budget's really not top of the pile at all, is it, Mike? Mike, thanks for that. Mike mentioned the difficulties this morning. First Republic is down about 31%. Katie Lyons is going to join us a little bit later, going into the opening bout to build on some of that. Maria, 11 minutes away. In fact, it's only about 9 minutes away now for an ECB rate decision. We thought this was easy. It was 50, and then maybe they commit to another 50. Maria, what's in store now?
Jonathan, just how much the narrative has changed. Remember, up until a week ago, this was a central bank that was an automatic pilot. You were going to hike 50 basis points. Everyone was focused on the guidance when it comes to May, and it was all about that core sticky inflation that the European Central Bank had to combat at that point. Obviously, a lot of that has changed over the past 72 hours. Big debate over 50 or 25 basis points. Will it be the data or the volatility in markets that essentially wins the argument? Now, two things, obviously, we want to focus on. Well, decision, of course, but then secondly, what kind of consensus was there behind that decision? And then it comes down to the communication. This comes down to Madame Lagarde. She is the head of the central bank. This is the woman that really has a job to instill confidence in the market. Can she get the tone right? To me, this is going to be a press conference really worth watching every minute of it.
We'll catch up with you very shortly. Maria, Ollie, Mike McKee, to the three of you, thank you. 9:15, the decision. Mike McKee's going to break that down for you. Maria's going to react to it 30 minutes after that. So in about 40 minutes from now, you'll hear from President Lagarde in the ECB news conference as well. Joining us now to discuss, Invesco's Alessio De Longis, Pictet's Ella Hodja, TPW's Jay Poloski. To the three of you, thanks for being with us. We are about 23 minutes away from the opening bell. Equity futures are only down about 1/3 of 1%. Ella, you said this. It's seek and destroy mode. It's time to question everything. Is it that bad?
Well, I don't want to scaremonger, but I mean, once you're hitting a sort of systemic global bank, then yes, the answer is it's a serious case. Now, of course, we've had action from the central bank overnight, so some calm has returned to markets. But of course, back to the point of seek and destroy, this is the sort of environment where you're shaking confidence in investors, and so we don't have the full picture, and we also understand that there's probably problems elsewhere within the banking system.
Jay, with that in mind, for a lot of people, it feels like the world has changed. The world has changed and our views should change. Have your views changed?
Well, John, I think not essentially, no. To me, I think we need to expect authorities to be able to both walk and chew gum at the same time. So we've had the Fed come out with their bank term funding program. JP Morgan suggests it could provide up to $2 trillion of liquidity. Overnight, we had the Swiss National Bank announce that they would provide up to $50 billion in capital and liquidity to Credit Suisse, which is equal to 6% of GDP for Switzerland. So the authorities have thrown a big blanket over the issues. I do not think the issues are systemic. Credit Suisse has been the sick man of European banking for years. SVP is the big winner from the zero interest rate policy, and that has reversed and they've been taken out. So it's not in any way, in my view, systemic. And so I think the authorities have thrown the blanket over the fire. They've put it out, essentially. And now we're going to go ahead and raise rates to deal with the inflation issue. I continue to think we'll see 50 basis points here in 10 minutes or so and 25 basis points next week from the Fed.
You're not alone. Citi sees the same thing. 50 in about 5 minutes, 25 next week. Alessio, do you think it's a mistake to try and isolate the banking issues of the last week from any monetary policy decision?
Well, I would say from a perspective of a central bank, let's define what that mistake is. I agree with Jay that the situation has not changed from a structural or systemic standpoint. Let's talk about the cyclical downturn, though. What is the issue with waiting how the dust settles for 1 or 2 months? The ECB, just like any other central bank, they're targeting lagging indicators. Actual inflation or the actual unemployment rate, those are two unquestionably lagging indicators of the cycle. Inflation expectations are at 2%. So from that standpoint, there is no sense of urgency. Now, I think raising 50, raising 25 is the right thing to do, was the right thing to do up until last week. But what is the issue with waiting today, how the situation is settling from a credit transmission standpoint, from a credit spread standpoint? One possible path here would be to do nothing or just do 25 and quantify how much this market turmoil and tightening in credit conditions is actually equivalent to an interest rate hike, and then reassess a month from now, 2 months from now. I don't see a big problem from that if they handle the communication in a very clever way.
They'll be criticised for whatever they do today. There is no great decision. There is no easy decision. Ella, something we talked about all through this morning, all this week. What would spook you more, if they hiked 50 or if they didn't hike at all?
Well, the suspicion is if they do 50, then clearly it's another mistake of the type we saw back in 08 and 2011, and we know what happened back then. And then so the markets would probably take a cue from that. I suspect maybe if they do nothing might cause some panic, and that is because, you know, what do they know that we don't know? So that type of analogy. Yeah, so absolutely. I mean, they're doomed if they do, doomed if they don't. And let's see the communication. But, you know, you have failures and successes in the communication from Lagarde. So I'm not 100% confident. She has become better at communicating with markets, nothing like Draghi used to be. But there are certainly risks both around the decision and the communication channel.
Jay, it's always slightly different. There's never a perfect parallel. There is a fear, though. We've talked so much about Chairman Powell being Burns or Volcker. Does Lagarde face a Trichet moment right now?
I don't really think so, John. Again, I mean, European banks are very well capitalized. Credit Suisse is a tiny, I know it's systemically important, one of the 30 global institutions, but from a perspective of markets more broadly, it's a very small perspective or point of view. It's less than 1% of the European Bank Index, for example. So I don't see this, I really don't see this as being as critical a moment as people think. The European equity market's still well above its 200-day moving average, up 4% year to date. The S&P holding up well above important technical levels after all the bad news that we've had. So to me, I think this is not as critical an issue as it's being made out to be.
Well, Alessio, your views have changed. The last time you and I spoke, you were pretty constructive on markets. From what I see in your notes so far, you're not anymore.
Correct. In early March, we moved from a growth and cyclical standpoint, unrelated to the events that we're talking about today. We have moved into a more defensive positioning. We assessed that the rally that we saw between December and February across all risk assets in relative and absolute terms was a little too fast and too far, reflecting the optimism on inflation, which then started walking back. So we moved to a defensive positioning for other reasons. The developments of the last 3-4 days have only been a fortuitous catalyst for that price action to play out more quickly. But we believe we are back into a mode of growth deceleration, of growth expectations decelerating, and a more policy, tighter policy for longer is probably the answer at this stage. We need to see what this repricing is doing. I think this repricing is bringing down business and consumer confidence and is tightening credit conditions. So we remain defensive for now, and that's why we think monetary policy should also take a pause and assess the transmission mechanism into the real economy that is coming from this financial shock.
We can't pause, that's for sure. We're 1 minute away from that ECB decision. Alessio, Ella, Jay, they're going to stick with us as we work through it. Going into that decision, this is what we're looking for, a 50 basis point move. It feels like the world has changed in the last week. Let's see if that call changes in about 30 seconds. Equity futures going into the opening bell. Negative, not by much, by a third of 1% on the S&P. In the Treasury market, the stage set as follows: 2s, 10s, 30s, 2-year unchanged, 3.88, anything but unchanged in the last week, from north of 5 to south of 4. Looking at the European bond market, let's take a flavour of things for you. Italy, Germany, yields pretty well behaved going into this one, at least this morning. And finally, euro dollar. This is how we're set up going into this ECB call. Euro dollar just south of 106, 105.96, positive 0.2 of 1%. That ECB decision, Mike McKee, is out.
50 basis points it is. The ECB still focused on inflation. The deposit rate goes up to 3% from 2.5%. The main refinancing rate is also raised by 50 basis points. They see inflation at 5.3% for 2023. That's a dramatic drop from 6.8, which was what their forecast was the last time they made it. They are going to, they say, continue to apply flexibility in the PEP purchases, which is no surprise. Here's a number on inflation in 2024, falling all the way to 2.9%. They are projecting that it will remain too high for too long, which brings you to that 50 basis point move. Now the question is, what do they say about the future? Because at this point, they had come out last time in February and said we were going to raise 50 basis points today, so they did. But do they say that they're going to do that again? They had projected that they would go more data dependent, and we're waiting to see if that's exactly the way they end up today.
They say they're monitoring current market tensions closely. We'd expect a headline like that. Mike, they think that inflation is going to be too high for too long. This is the projections, though, Mike. I just wonder, what are these projections worth in a moment like this one? And we're going to replay this act next week with the Federal Reserve as well.
Well, I'm looking through the statement now, and they do note that, and this is a quote, the elevated level of uncertainty reinforces the importance of a data-dependent approach to the Governing Council's policy rate decisions. And they say they're going to determine it based on their assessment of the inflation outlook. They do have that one pillar where the Fed has two, but the ECB moving now to where the Fed is and saying that we're going to be data dependent. We're going to look at what's happening with the inflation numbers. And we, as I noted, are seeing them lower their inflation forecast to 5.8% for 2023, but suggesting that's still too high.
Mike, that line there that's just popped out. The ECB is ready to respond on price stability, on financial stability. Mike McKee, right now, are those two things in conflict?
They shouldn't be. That's the thing about the way central banking has developed over the last 20 years or so. It started with Ben Bernanke, the idea of separation of powers, where you would use supervisory and regulatory rules to deal with the financial stability world, and monetary policy to deal only with, in the Fed's case, inflation and jobs, in the ECB's case, only inflation. The question is, do you get some sort of market disturbance that is so bad that they have to bring monetary policy into it, as they did, all the central banks did in March of 2020 with the pandemic, and they did following the collapse of Lehman Brothers. But if you have just an ordinary sort of problem with one bank or a couple of isolated banks, it probably doesn't make a difference. They will perhaps bail out a bank if necessary. The Swiss did, the U.S. did. But it doesn't suggest that the ECB is going to make any kind of massive monetary policy change.
50 basis points from the ECB, just about 106 on euro dollar outside of ECB HQ, just 25 minutes away from this news conference. Maria Tadeo. Maria, your reaction to this one?
Well, this is a European Central Bank that has decided to stick to the script and obviously stay with the 50 basis points. And, you know, we're talking about this the entire morning. This was a tug of war between the data, which obviously points to inflation mission not accomplished, to bring it back to target. We're actually focused on the volatility and the now in the moment. And it is the data that seems to have won this argument. Now, a number of things that I really want to focus on in this press conference is what kind of consensus did they get to reach this decision? Just how unanimous was it? Then secondly, there's another line here that says the European Central Bank has a toolkit that's equipped to provide liquidity support if needed. It'll be interesting to see what would deploy that. And then secondly, overall, just as message from Christine Lagarde, what is the rationale to make a move like this? And then can she really provide and shore up confidence for investors after this move, which herself she had calibrated very well a month ago and said would only be derailed in extreme scenarios. So it seems for the time being, clearly they do not see spillover from Credit Suisse as extreme enough to prompt a U-turn.
Hey, Maria, thanks for that. 50 basis points from the ECB and absolutely no guidance whatsoever as to what we might get next. Back with us, Alessio, Ella, Jay. I want to give you each the opportunity to respond to what you've heard in the last 5 minutes. Ella, first to you.
Well, not a surprise on the 50, given that's what they've been guiding and pre-committed before this meeting. Whether it's the right thing to do, we'll see. As we were saying earlier, this might be third time unlucky for them. Probably the wrong time, and markets were already discounting that this is likely to be the peak in rates. What do you do with it? I would actually say you buy duration here. So you buy rates, you buy duration further out in the curve potentially. We've been moving more in shorter maturities in the US. But the reason you do that is because banks are really about confidence, and we do have a bit of a crisis of confidence at the moment. So that's number one. Number two, you do lack a European-wide deposit guarantee. I mean, this is something that we dealt with back in the Eurozone crisis. And so it might be a little bit more tricky to shore up Europe in the same way as you might have done in the US. So I don't think this is over, and potentially this hike today might have made things potentially worse despite this liquidity option that's being put on the table.
Jay Pawlowski, your take.
Yeah, the thing that I wanted to see, John, was their forecast changes, and I saw across the tape there, they lowered, as Mike said, their inflation expectations for this year and next, and they raised their GDP forecast for this year. And I think that's really the critical issue. If this is not systemic, we have slowed, if not stopped, the interest rate hiking cycle, particularly from the Fed. I think less so from the ECB. After next week, I think the Fed goes on hold. And therefore, that's really the key issue. To me, the most important thing here is that the battle for 2% inflation in the U.S. and probably in Europe has been fought and lost. In other words, we can't take inflation right down to 2% because we're going to break the economy. And I think that's really the key point. So if you're a medium to long-term investor, I think the opportunity set here is to look for opportunities, be a buyer rather than a seller, particularly in areas of strength. And there are many areas of strength still within the global equity markets, even after the past week. In fact, all the weakness has demonstrated where the pockets of strength are.
The problem is where we thought strength was, it looks like weakness now, particularly the banking sector. Alessio, your take, please.
Yeah, my take is that this is probably the last hike. I'll be very interested in hearing more of the communication today. I think it can be justified with ample liquidity tools made available to banks. So you separate the question between the growth and inflation outlook from the plumbing of the financial system. From an asset allocation standpoint, I think this reiterates an environment where I agree, longer duration exposure, underweight credit, and still a solid perspective on equities, but with a defensive bias away from cyclical. So I think this is an environment where credit is the asset class that stands out to have the least upside potential and still some meaningful growth sensitivity, which you don't necessarily want here. Quality bias and defensive sectors in equity as a way to stay engaged in the equity market, but with a defensive tilt.
We'll keep this conversation going on your market calls. Though, Alessio, for a lot of people just tuning in, and if you are, welcome to the programme. 50 basis points from the ECB, as expected for much of the last month since the last meeting, but of course the last week raised some questions about whether they would deliver. They have. Alessio, can you read anything into what the Fed might do next week based on what Lagarde has just done right now?
25 basis points, probably my base case for the Fed, depending on how we get there.
Do you agree, Ella?
It's possible. I mean, central banks found this new religion, but I think that ship has sailed. You know, the market dynamics are now ahead of that. And the only thing that stops this route is the central bank policy put, unfortunately, which, given the context of inflation that we have, could potentially be good for assets down the road. I agree with Jay on that point. But at this juncture, the pressure needs to come first. And so we would be much more cautious here until markets can stabilize.
What about you, Jay? Not the market call, just the Fed call for next week. Is there something to take away from the ECB and apply it to the thinking of this Federal Reserve next week?
Yeah, I mean, to me, it's 25 basis points and then they go on hold. I don't expect them to cut rates like the market is pricing in because we don't expect a recession. I would just note, you know, Morgan Stanley raised their Q1 GDP forecast yesterday to 2%. Goldman put a circle around what the effect of SVP is likely to be on growth in the U.S. at Q4, took their Q4 number down 0.3%. So when you have the big scary monster out there and no one really knows what's going on, it can be anything. And now we're getting our hands around the likely impact of this. And to me, it's no longer as scary. I'll take 0.3 off Goldman's Q4 GDP estimate for a Fed recognizing it's not going to be able to take inflation straight back to 2%. There's been a lot of discussion around changing the inflation target, moving it up to 3%. I think that debate, as I mentioned earlier, is done. We are not going to 2%. The Fed is going to gradually see inflation decline, and we are entering a high nominal growth world that is going to be constructive for risk assets. We have gotten through COVID. We're about to get through the inflation cycle. And what's on the other side is a significant policy shift towards a high nominal growth world driven by a global capex boom.
Jay, this feels like therapy to help market bulls sleep well at night. Jay Pawlowski, Ella Hodger, Alessia DeLongis going to stick with us. Equity futures right now down 0.6%. Coming up, counting down to President Lagarde.
Oftentimes, the schedule works out so that the ECB moves the day after the Fed. This spring, they're moving a week before, and I do think all eyes on the ECB.
That conversation up next. The ECB goes 50. The Federal Reserve, it's your turn next week. It wouldn't be the first time the ECB has hiked into some trouble. 2008, 2011, will it be a three-peat? We got 50 basis points just 15 minutes ago. 15 minutes ahead, we've got President Lagarde. Equity futures down 0.6% on the S&P. On the Nasdaq 100, we're down 0.25%. There's the opening bow. Switch up the board and get to the bond market. Yields look a little something like this. Down 5 on a 10-year, 3.40 on a 2-year. Trading like a penny stock for the last week or so. Your 2-year yield all over the place. Up, down, 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 up, and now up 2 basis points. 2.39 on a German 2-year. Over in the United States, in the Treasury market, we're higher this morning by a couple of basis points as well. On a 2-year, we're back to about 3.88, almost unchanged now in the Treasury market. Elsewhere in the FX market, euro dollar 105.78, unchanged there as well. Reclaimed 106 very briefly going into the ECB, and crude again. Look at this in the 60s, 66.70 on WTI. We're down by 1.3% on WTI crude. We're about 40 seconds into the session. We open lower by 0.5% on the S&P. On the Nasdaq, down 1/3%. All over the banks now for a week. The turmoil continues as Credit Suisse plots its next steps. Looking in the United States, we need to talk about Republic Bank, exploring its options, including a sale. The stock getting hammered by more than 30%. Kelly Lyons has more. Hey, Kaylee.
Hey, John, yeah, getting hammered once again. Remember, this is a stock that has already lost $17 billion in market value over the course of just a week. And as you said, another 30% drop this morning, which is unusual considering usually when we get reports that a company is considering a sale, the stock goes higher. It finds support on that message. That is not the case when you are a bank that has just been downgraded to junk by two credit agencies because of concern about deposit outflows. And you have this mark-to-market accounting on loans that is going to wipe out shareholder value potentially in the case of a sale. Hence the reason why First Republic is down so hard, and that's bleeding through to some of those other regionals that have been under continued pressure over the course of the last week. Right now, PacWest down about 13%, Western Alliance down by 8%. As for some of the too big to fail banks, we are seeing a little pressure there as well, though not to the same degree. The likes of JP Morgan and Bank of America each down by about 1% today, as is the S&P 500 financial sector overall, at least in the first few minutes of trading here. So once again, we find these more diversified banks a bit more insulated to the pressure we are seeing in the regional banks. And of course, First Republic, as I said, chief among those today. This is a fun chart for you, though, John. Even if this 30% drop in First Republic shares today holds, its price to book ratio will still be twice that of Credit Suisse. And I'm just going to leave it on that note, John.
We'll leave it on that point. That stock getting absolutely hammered at the opening bow by about 35%. As Katie pointed out, the team here at Bloomberg reporting just yesterday evening that they might be mulling a sale. Of course, the downgrade to junk came from the likes of S&P Global Ratings and Fitch in the last day or so as well. Looking at Credit Suisse over in Swiss trading, still higher by more than 20%. The news, 1:45 a.m. Zurich time overnight. The SMB providing 50 billion Swiss francs. That's the announcement from Credit Suisse overnight. 50 billion Swiss. There's your central bank aid. Marion Hoftemeyer joins us now from Zurich. She's been up for the last 2 days or so. Marion, is that sufficient?
That is the big question, and that's what we're trying to assess today, is whether it's sufficient. The bank says it is sufficient. They didn't feel like they even needed it to begin with, but it was a reaction to just the sell down we saw yesterday and the absolute chaos and panic across markets for everything Credit Suisse. So that's the hope, is that this and their bond buyback will sort of put a floor on that and act as a circuit breaker in a sense, to get things back on track and get things more stable for them to actually complete a restructuring that they're in the process of doing.
Marion, we know that they wanted a public statement, a statement of support from the regulator, from the Swiss National Bank. They got one yesterday afternoon. Clearly, they've tapped some of the aid, the liquidity provided from the central bank too. We reported, Marion, yesterday that another option, beyond just a public statement and doing exactly this, other ideas include a separation of the Swiss unit, a tie-up with UBS. How seriously are those things being taken this morning in Switzerland?
They are still top of mind. I mean, the situation is not completely resolved. It will play out in the next couple of days, because one of the key things here is that, yes, they have liquidity and they have capital. However, the headlines and the amount of just panic that happened will have eventually potentially an impact on business. So what we'll be watching in the next couple of days is just how much business has been impacted, from the sense of, are clients panicking and stopping doing business with Credit Suisse? Have there been another massive outflows from wealthy clients? And what does that mean for the whole turnaround plan? If some of that starts to jeopardize the turnaround plan, we might have to see some of these other options come back to the table of, do we split out the Swiss bank? Do we force a merger with UBS? What are the other options in order to really solve for the situation?
Marion, thank you. Credit Suisse right now up 23%, though still in and around 2 Swiss francs a share, which is hardly ideal for that company right now. There is a turnaround in the German bond market. Yields were higher at the front end of the curve. They're now lower by a couple of basis points, 235, 236-ish at the front end of the German curve. Bear this in mind. The high of the year, in fact, the multi-year high for the front end of the curve has been through 300 basis points. It was only last week, I think, we saw 338 on a German 2-year. And that wasn't just about the 50 basis points people expected today. It was the 50 maybe after that. And if you pay any attention to the Austrian central bank governor, it was the 50 after that, the 50 after that. And clearly, it's a clean slate now for the European Central Bank and the Governing Council. Data dependence going forward, and I wonder how much of a data point Credit Suisse will be for that ECB. Back with us, Alessio De Longis, Ella Hodger, Jay Poloski. Ella Hodger, Bob Michael, JP Morgan. This programme 24 hours ago in a seat just over there in the studio, turned around and said this was the tip of the iceberg, that this could get a whole lot worse. Do you agree?
Hi. I wasn't sure if that question was to me. Yeah, I mean, I think we've had a series now of problems, and a majority of problems actually began since last year. It's probably the most aggressive repricing of monetary policy globally that we've had, certainly since the 1980s. So it's a pretty aggressive move. So very much a boom-bust type of cycle. So, hot inflation followed by very steep rate increases. You were going. And so we've seen that happen. Very difficult to say here how that pans out, right? But as we were saying earlier, the market is in this seek and destroy mode. So it will be seeking those weak links, whether it's smaller banks or less capitalized banks or potentially insurers that may have liability mismatches, et cetera, et cetera. So the problem is in the pipeline. However, we have to take a step back and realize that there is very little appetite for systemic risk from the central banks. And you saw that with the Fed intervention last weekend. You saw it overnight with the S&P intervention. So we do potentially need more acute pressure points to increase the amount of intervention, but we have begun that process already. And I think that's what the bond markets are responding to. So potentially easing of policy down the road. We hear defense on programs like this a lot at the moment in an environment like this one. Defense, and when I ask what defense is, I'll be told high quality assets, investment grade credit. Now, Alessio, you like IG. The problem is with IG that I have at the moment is that someone might have said that to me a week ago and SVB was IG. Alessio, can you walk me through what you actually like in investment grade?
As an asset allocator, we focus on the broader asset classes and we really focus on duration targets, credit targets. Diversification is the name of the game in asset allocation. You delegate the security selection to the experts. So why do we like IG? At 5-6, and anytime you get an opportunity to lock in 5-6% yields between the government bond component and the credit spread on top of it, we're talking about yields that we haven't seen since 2007. And we've been starving for yield for that long. IG offers today, and maybe the lower quality IG, if you want to push the risk frontier a little bit more, offers potentially mid to high single-digit returns, equity-like returns with much lower volatility. So again, in an asset allocation context, you want to have a exposure to many asset classes, but quality investment grade, especially versus its recent history, represents a unique opportunity at this stage in the cycle. Look at the price action. It's not systemic, but markets have reacted with a marginal defensive tilt to the announcement.
Ella, can you say the same thing?
Well, I don't know. I'm a bond girl, I suppose, but we start with the central banks. And, when you have curves starting to re-steepen, so bull steepen, after protracted inversions of the types of inversion we've had in the U.S. market, for example, until now, it tells you a recession is imminent, right? And credit doesn't perform well going into that. And so for us, actually, U.S. investment grade credit is an underweight. So in the total return portfolios is actually an outright short. So we would probably have a different perspective to that. We want to be closer to home, closer to core duration. Perhaps in European investment grade credit, there might be some spots of interest, but broadly speaking, we are very, very conservative here.
Ajay, I promise you the time to talk about it. You're not conservative, you're constructive still. Let's talk about the opportunities that you see right now. Where are they?
Yeah, John, I think we've sped up or accelerated the end of the Fed rate tightening cycle. I think that means that the dollar strength that is the big worry is not going to manifest. We expect continued dollar weakness. I think that suggests that the opportunity set really is outside the United States. As you know, you and I have been talking about for probably well over a year at this point, at least. And therefore, that's where we see the opportunity set. So we're a global multi-asset at TPW Advisory, and we're significantly underweight fixed income. We're overweight equities and overweight commodities. We like Europe, strongest region in the world, Japan, a quiet winter, China, growth recovery, and Mexico, supply chain reshaping winter. We think there are opportunities in the tech sector, particularly around robotics and semiconductors. And we like the home builders in the U.S., obviously lower rates, good for mortgages. We think the home builders bottomed late last year. So that's really the opportunity set as we see it. We added to several of those positions last week in our monthly model rebalancing, and we're comfortable holding them. And we think banks are going to be okay as well. European banks, John, even after the shellacking of the last couple of weeks, still well above their 200-day moving average. I think if you have a stomach for some near-term volatility with a long-term outlook, I think you can look to add to some of the banking positions in Europe and elsewhere around the world that have been hit by this volatility. But yes, we remain constructive. The Fed tightening is approaching the end. We're about to launch a rate cutting cycle led by the emerging markets and enter a new global growth cycle as we exit 2023. And that's where investors should be paying attention, not the fallout of the rate cycle that's finishing, but the upside from the rate cutting cycle that is about to begin.
Jay, I feel like you missed a bit. It feels like you're playing the recovery to the recession we've not had yet.
We're not going to have a recession, John. I've been saying that for 6 months. We're not going to have one.
You think we're not going to have one? Let's work through this. Dan Iverson, PIMCO. Let me just get through it, Jay. Dan Iverson, PIMCO, turned around and said multi-month process. Wait and see. Bob Michael, JP Morgan Asset Management. He said, regardless of what you think these central banks are going to do, financial conditions will tighten, lending standards will tighten. What would you say back to that?
Yeah, I touched on it earlier, John. Goldman put a circle around the effect of the credit, limiting credit at 0.3% of 1% of GDP for Q4. All right, so that's fine. I'll accept that for a Fed that is not going to tighten to get inflation down to 2%. That to me is the real key. The debate has been over, does the Fed have to tighten to get inflation down to 2%? The action over the last week tells us there's no way they can do that because already the zero interest rate policy winners are cracking at inflation at still 5%. We're going to work inflation down to 3%, and that's going to be an undeclared victory, in my opinion. The rest of the world, John, is accelerating. China, the second biggest economy in the world, is going to grow 6% this year versus 3% last year. So I don't see any major imbalance in the U.S. to cause a recession. Consumer fine, corporates fine, and notwithstanding the last week banking sector fine, very heavily reserved, tons of cash on hand. So yes, tempest in a teapot here over the last week or so. Looking out 3 to 6 months, I think we're going to be materially higher, particularly outside the U.S., looking for 10 to 20% total return in U.S. dollars from non-U.S. equity this year.
Wow. Jay, I always feel like I walk away from a conversation with you thinking that's a trade for the brave. Jay Pawlowski, Alessio De Longis, Ella Hodger, to the three of you. Thank you, mate.
Including stupid, but brave is, I'll take brave.
Thank you, sir, as always. Jay's not alone, let's be clear. Neil Dutter of Renmac earlier this morning was talking about the US economy. He said Atlanta Now GDP tracker, something like a 3 handle, said look at where inflation is. That's a high nominal GDP world. And one thing that Neil almost does every single day at the moment is say, look at the home builders. Jay said it just moments ago. The home builders in America right now, even with all this as your backdrop, the home builders in America up 0.9% on the S&P. I just want to squeeze in what's happening elsewhere and get some bank names with Katie Lyons down in DC. Katie, some big moves.
Some big moves and some more volatility halts. Both First Republic and Western Alliance were halted for volatility. They have resumed trading once again right now. First Republic down about 30% after Bloomberg reported it is exploring options, including potentially a sale. And Western Alliance down about 13% after being placed on watch negative by Fitch. Remember, First Republic already downgraded by both Fitch and S&P ratings to junk yesterday. We're on watch negative for Western Alliance. Both of these regional banks under immense pressure once again in today's session, John.